A very good day, everyone. I'm Avinash. My matrix number is 264756. So today I'm going to talk about treasury instruments we have chosen for the group assignment. So we have chosen three treasury instruments. First is repurchase agreements and corporate bonds and the Malaysian government securities. Before I continue further, let me introduce my group mates. They are Sandhya, Vinoda, Kavinisha and Sangeeta. So first I'm going to tell about the definition. So the definition for repurchase agreement is a repo, also known as the repurchase agreement. The bank sells its money market instrument endorsed by Bank Negara Malaysia to a financial specialist with the comprehension to repurchase the instruments at an agreed price on a particular future date. A repo offers adaptability on the grounds that the tenor ranges from 1 day to 1 year and speculators can retire the transaction earlier, subject to rate modification should they need the funds prior to maturity. Next is corporate bonds. So the corporate bonds are the point when you purchase a bond, you are lending cash to the corporation that gave it. The corporation guarantees to return your money, not as principal on the specified maturity date. In contrast to stocks, bonds do not give you proprietorship interest for the issuing corporation. For Malaysian government securities, MGS is coupon-bearing long-term bonds issued by the government to increase funds for development expenditures. They have been the most actively traded bonds. The BNM regularly issues 3-year, 5-year, 7-year and a 10-year MBS benchmark securities for the event of a benchmark yield curve. Moreover, 15-year and 20-year MBS have also been issued to lengthen the yield curve. Next, we are going to see the purpose of its creation. For first, repurchase agreement. Repurchase agreement are usually used to raise short-term capital. Repo and reverse repo were used prior to financial crisis to adjust the supply of reserve balances and keep the federal funds rate around the target level. Next is Malaysian government securities. Malaysian government protection were given to satisfy the speculation needs of the Employment Provident Fund, as also known as EPF, neighborhood banks and insurance agencies. Conversely, by the 1990s, the motivation behind MJ's issuance was stretched out to subsidizing a piece of the government spending shortage and prepayment of some of the government external loans. And for corporate bonds are debt instruments made by organizations with the goal of raising capital. A bond functions as a credit between an investor and a corporation. So we are going to see how the treasury instruments are created. First of all, we are going to tell about repurchase agreement. If a dealer sells government securities to investors, basically on an overnight basis, and buys them back the following day at a slightly overpriced. Next is for corporate bonds. At the point when you purchase bonds, you are basically lending money to an organization for a predetermined time frame, known as a bonds term. The period be 5 years or 10 years, contingent upon the organization's needs. The organization in turn guaranteed to pay you a particular amount of interest on that credit and repay you underlying investment principal when your bond develops or comes due towards the deadline of its terms. And lastly, Malaysian government securities. Their tendering is completed through the fully automated system for tendering, whereby the coupon rate is detected by the weighted average of the effective bids. Coupon payments are made semi-annually. Successful bidders are determined consistent with the lowest yields offered and also the coupon rate is fixed at the weighted average yield of successful bids. So that's all from me. Thank you.
Hi, my name is Sangeeta Sadakumar, matrix number 264518. I will be presenting about the parties involved, their rights and their responsibilities for the three instruments. Repurchase agreements. Seller, the short-term borrower, and purchaser, the short-term lender. For corporate bonds, issuer. Various issuers involve banks and corporate entities that issue protections to help their task. And investor, individual who buys the commitment that is given in the market. Malaysian government securities, issuer, Government of Malaysia, and investors. Rights of each parties. For repurchase agreements, Seller, an individual, sells some security to the purchaser in return for a sum of cash. The seller moves the ownership for security, repurchasing it inside 30 days. In the event the seller defaults on his commitments, purchaser provides the seller a money loan collateralized by the securities the seller offered to. The purchaser has the right to sell the security or use it to gain profit. For corporate bonds, issuer. If at any case the bond issuer become bankrupt, the organization's assets may be traded to repay the leases, including the bondholders. Investor. Through a broker, investors can purchase individual corporate bonds. Investors can contribute through exchange-traded funds (ETFs) or mutual funds that is significant on corporate bonds. For Malaysian government securities, typically denominated in the nation's own currency, where case the government cannot be compelled to default, despite the fact that it might decide to do as such. Investor, the bondholders never experience losses in their important venture, and they do have the priority over investor, where if there should arise a bankruptcy, bondholders will be repaid first. Responsibility of each parties. For repurchase agreements, seller. Although this basically a guaranteed exchange, the seller may not repurchase the security sold at the date. Purchaser. The purchaser holds the collateral and guarantees that the seller gets money toward the start of the agreement and that the purchaser moves assets for the seller's advantage and passes on securities at the maturation. The security anyway may have lost an incentive since the start of exchange, as the security is prone to market movements. For corporate bonds, issuer. Duty of an issuer is to arrange copy of record and commitment of record name of enlisted proprietor. Every issuer will make entry to the safe copies of the remarkable records in respect of insurance held by such safe. The issuer has commitment to show up or issue the testament of assurances on quitting a safe by the investors in less than the time demonstrated under this Act or guidelines. Investor. If the organization runs into inconveniences, in any case it has a genuine commitment to make suitable hire purchase of interest and principal. The organization has no relative commitment to convey profits to investors. In bankruptcy, bond financial specialists have need over investors in claims of the association's assets. For Malaysian government securities, issuer guaranteed to pay periodical interest payments and to repay the face value on the date. For investors, investment returns will be fixed. Bonds will be unprotected if the government that issues them enters a fiscal crisis that raises doubts about whether debt obligations are honored. That's all from me. Thank you.
Very good day. I'm Kavinisha Dr. Vincent and my metric number is 256241. Today I'm here to present about what are the risks to each parties in a repurchase agreement, corporate bonds, Malaysian government securities. First of all, the risk to each parties in a repurchase agreement, where the seller has the greatest danger in a repo being that by not repurchasing the securities, it sells at the maturity date, where the seller may refuse to keep back its end of the deal. Whereas, the protection buyer can then liquidate the protection to seek and reclaim the cash it initially paid out. Corporate bonds. There are various types of risk, which is call risk, liquidity risk, and event risk. The call risk explains that all bond specifics grant the corporation the luxury of repurchasing the bond before maturity date. This is known as bond calling and it speaks to bondholders of call risk. The next will be liquidity risk, where the capacity to sell an asset when the investors chooses a bond for capital. Bonds that are traded as often as possible at large rates will provide greater value than bonds that traded fewer every now and then. Liquidity danger is the possibility that creditors who want to sell their shares cannot get a return that matches the bond's true estimation. And followed by the event risk, where the risk that a corporate exchange, natural disaster or administrative change will cause a sudden minimization in a corporate bond. Event risk will in general change by industry area. For instance, if the telecom business happens to combine, at that point event risk may run high for all bonds in this part. The risk is that the bondholders company may buy another telecom company and potentially increment its obligation trouble all the while. And for the Malaysian government securities, although government bonds bear little risk of default, they are not risk-free investment, meaning bond prices decline as interest rate rise and vice versa. As seen with the debt crisis in Greece, governments are not always able to generate more money. This doesn't keep them from defaulting on loan payments, and although they do, apart from default danger, for government bonds such as debt danger, price risk and currency risk, there are a couple other possible risks to look out for. Moving to the next part, the return and benefits to each party. The return and benefits to each party in repurchase agreement are: the seller or creditor provides the right to spend cash instantly, rendering them a vital component of the liquidity management campaign. In comparison, owing to a shortage of liquidity, borrower or seller may require short-term funding. And for the corporate bond, issuing of debt helps corporation to prosper even quicker than if it had initially intended to raise and preserve money. If the company is good though, you might see better earnings and an increasing share price. Other than that, Malaysian government securities, where investors will possibly invest in bonds because they promised a fixed return and will be able to forecast the revenue earned while rendering their investment healthier and less volatile. Interest payment is semi-annual, where the coupon rate is calculated market dependent on the issue's weight average effective yield. Moving to the next part. What are the pricing mechanisms for a repurchase agreement? A repurchase premium, the repurchase rate is simply the price tag, where the justification is the money spent by the money loan professional plus any received premium. If a trim or original margin is involved, then we ought to take it into consideration. Followed by the corporate bonds. The pricing mechanism, where the selling of the substantial amount of bonds that are a piece of scraped branches is currently performed on a dirty level. A dirty price is a value expressed in terms of the bond's face value and has attached to it the accumulated interest portion. Bonds are exchanged in debt over counter market on safe price and yield. Clean bond price is the cost of a bond communicated in 100 basis points and the accrued interest is rejected. Yield of a bond is the yield that equates the small expectation of potential cash flow to the bond's present expense. The OTC duty segment exchange intends to transfer the selling of a portion of the clean price and yield instrument of corporate and government bonds. The broker has an option to entering request using clean price or yield in the trading portion clean price and yield. Last but not least, for the Malaysian government securities. Malaysian government securities is provided to tendering to designated principal dealers. Tendering is achieved through the fully automated tendering process, whereby the coupon rate is calculated by the weighted average of active offers based on the value of a comparable maturity government bond. Coupon rate and duration. The quality and the credit value. Apart from that, in fact, The sort of debt, whether reported or in the form of a issuer, liquidity dimension of a debt and taxes.
Hi, next I would like to explain how is the instrument traded. For the repurchase agreement, is traded where both parties agree to the sale and future repurchase of asset in a specific contract period. A dealer will sell the securities, which consists of agreement to buy them back at a different price more than original price in future. The dealer is raising short-term funds with a favorable interest rate at a smaller risk. At a smaller risk. The transaction is completed with a reverse repo. As short, the repurchase agreement is traded when the seller sells Treasury bills or other government securities with a promise to buy it back at a specific date and at a specific price that includes an interest payment. Okay, next, for the corporate bonds, is traded in decentralized dealer-based over-the-counter markets. The dealer play its roles as intermediaries in between buyers and sellers in over-the-counter trading. Corporate bond is listed in exchange which is known as listed bonds and ECS. Nevertheless, the most broad of trading take place over the counter. Next, for the MGS, the MGS are the most active free trade bonds. The appointed principal dealers issued the MGS via tender. The coupon rate is decided by the weighted average of the successful bids, whereby the tendering is settled via the fully automated system for tendering. MGS tenure is usually medium up to 30 years, which is long term. MGS is categorized as fixed rate coupon-bearing bonds with a bullet repayment of principal after maturity. Coupon payments are made semi-annually. Through competitive auction by Bank Negara Malaysia, the MGS are issued representing government. The announcement based on annual calendar that lay out the timing, tenure and issuance method, new issue or reopening will be declared at the end of the subsequent year to boost market transparency and reliability. A week before the issuance date, the original issuance size will be declined. Its range will be resultant from the financial requirement of the government, which is from 1 billion to 50 billion. Next, is there any secondary market for repurchase agreement, corporate bonds, Malaysian government securities, MGS? Okay, for the first one, repurchase agreement has no secondary market as direct placement only take place in the repurchase agreement. For the corporate bonds, it has secondary market. There are conditions when they may sell or forced to sell bonds before maturity. However, there are many bond investors employ a buyer and hold strategy. The marketplace where investors can buy and sell bonds is known as secondary markets. A key difference compared to primary is a market where new securities are issued in the market, whereas in the secondary market is the securities where already issued and existing securities are traded on the stock exchanges. For the Malaysian government securities, yes, there is also a secondary market for MGS. The liquid with standard transaction volume range from 100 million to 500 million, which is the benchmark securities of the secondary market. The standard transaction is 10 million per lot. Trades are settled in 2 business days, which is T plus 2, and are quoted on a price basis to 2 decimal places. The transfer of the securities are paid either stamp duty or commission. Brokerage fee is payable for transaction through money broker. Next, where and how can you access to this instrument? For the repurchase agreement, we can access through repurchase agreement transaction. These policy documents set out the revised prerequisite and forecast of the bank whereon licensed bank and licensed investment bank on market contributors. It helps to access in repurchase agreement through repurchase agreement transaction involving ringgit and non-ringgit repo and reverse repo transaction with an aim to redeem or resupply these repo securities at a future date. The enlargement of the maximum tenure of a repo to 5 years from 365 previously. The widening of eligible securities to accord flexibility to market participants in their performance of repo transaction. Removal of subjective termination annex and fallback on general recommended documentation principles such as GMRA or supplementary confirmation, and based on principle-based risk management, which approach in controlling of the repo product or the alteration to the policy document. Next, for the corporate bonds, we can access corporate bonds by buying them on the primary market through a brokerage firm, bank, bond trader, or broker, as the corporate bonds are issued by companies that want to raise additional cash. Some corporate bonds are repurchased and resale over the counter market, while it providing good liquidity. Before investing, it is advisable to learn some of the basics of corporate bonds, including how they priced, the risk associated with them, and how much interest they should pay. Next, the Malaysian for MGS, Malaysian Government Securities. We can access through MGS by buying almost any bond at your brokerage or local bank. Brokers charge a small commission over the markup to the bond price. Easy to clarify this with your broker before confirming that you want to buy. Government bonds are issued by national governments.
Next, I would like to explain about how does the instrument used in bank treasury operation. First instrument are repurchase agreement transaction. Repurchase agreement transaction is where the bank sells eligible security to banks and also commits to repurchase the equivalent securities on a specific date at a specific price which reflect the repo rates. Repurchase agreement transaction is used for transaction combining a sales of security with an agreement to reverse the transaction soon. They also used to manage and observe liquidity in the bank system for tenure ranging from overnight to 1 year. Repurchase agreement transaction also used for the aim of lending specific MGS requested by financial institutions to boost secondary market liquidity in the bond market. Second instrument are corporate bond. Corporate bond is type of debt security that issued by a firm and sold to investor. Corporate bonds have call provisions to allow for early repayment if prevailing interest rates changes so drastically that the company demands it will do better by issuing a new bond. Corporate bond its investors also can choose to sell bonds before they mature. Investors may additionally gain access to corporate bonds by investing in any number of bond-focused mutual funds or ETFs. And the third instrument are market government security. Market government security is a coupon-bearing long-term bonds issued by the government to raise funds for development expenditure. They may be wary of government bonds that can help government to raise more capital. The second question is, are there any official guidelines regulating this instrument? Yes, they do. In repurchase agreement transaction, the first official guideline is Capital Adequacy Framework, issued on 3 May 2019. The second is Single Counterparty Exposure Line Limit, issued on 9 July 2014. And the third is Foreign Exchange Administration Rule Code of Conduct for Malaysian Wholesale Financial Markets, issued on 13 May 2017. And the fourth are Net Stable Funding Ratio, issued on 31 July 2019. And the last is ST80 Smart Reporting Requirements on Data Submission for Reporting Entity, issued on 29 March 2019. And for corporate bond, the official guidelines is Security Commission Malaysia under Section 377 of the Capital Market and Service Act 2007. And the last under market government security, the guidelines are the Malaysian code of conduct for principals and brokers in the wholesale market and foreign exchange market issued by Bank Negara Malaysia. And last question is for our assignment is who are the regulating agency? For the repurchase agreement, the regulating agency are Federal Reserve. They are to manage the money supply and bank reserve. For corporate bonding, the regulating agency are Bank Negara Malaysia. They are responsible for the regulating of corporate bond issuance. For Malaysia government security, the regulating agency are Security Commission Malaysia, which represent SC. SC's responsibility is remaking ensure sustainable market growth and development, enforcing regulation regarding the capital market and supervising capital market activities and market institution license under the Capital Market and Service Act 2007. That's all from me. Thank you.